So the best thing about a panel called The Future of Fintech is we can say whatever we want, and 10 years from now you won't remember, so let's go out on a limb here. So I had 3 ideas of what the regulatory future could look like. Thank you for stealing mine. That was a great one. I couldn't agree more. I got to come up with a 3rd one when we get there. But to your point, it is good for platforms to be regulated like banks. Because it is all merging together. So I just want to agree with that, and I think it's good for all of us in the room ultimately. The other 2 I would say are, one, we talked a lot about transparency on the last panel. We talked about how in California, a group of us, LendingClub and some of the folks on stage before, Opportunity Fund and Funding Circle and our coalition, the Responsible Business Lending Coalition, passed a law in California. Small business is part of our portfolio, as was explained on the past panel. Passed a law in California in order to provide more transparency, so you knew what you were getting into as a small business taking on a loan, with protections that are somewhat like what consumers get today across the board, according to federal law and TILA. So we talked about on the last panel, and I think we should even go further than we discussed on the last panel, seeing more states now do that beyond California. But I think the answer is, and this is one where I think we can agree that a federal standard really makes sense, is that a TILA for small business at a national level, I'm going to put that on the prediction bucket for 5 to 10 years from now. It's just so inevitable with online lending, so inevitable with the benefits of transparency and access to credit for businesses. How could we not demand of ourselves a national standard on transparency? I think that's an easy one. A harder one is probably, second prediction is, so John Ryan might have agreed with that one. He's not here. He'll disagree with this one. There is a federalist compromise here. Rate caps made sense once upon a time at a state level. We really probably need a 36% thoughtful approach across the board, that as opposed to each state picking a random number out of their hat as a rate cap. That's really, there's no reason other than some historical vestige for that, for these random numbers, and they frankly do a lot of harm on access to credit than they do good at this point, because Congress has already come around the beginning of a 36% standard according to the Military Lending Act passed 2006. The CFPB very recently adopted a rule with a 36% standard. Some of that was repealed, but some of it is still in place, frankly. Their dichotomy between above 36 and below 36 still stands for some portions of the CFPB's rule. And the FDIC, we've seen issue guidance saying, hey, above 36%, be cautious, be thoughtful. So this has been coming around, and there's bills in Congress. There'll be more, I'm sure, this year emphasizing this. This is an appropriate place for a federal standard. There are places where it's less appropriate. There are times where you want the states. I was a former chief of staff of New York's bank regulator. You do want the states to have power to go beyond federal law, especially in times of fluctuation in administration, and to let the best rise to the top. Rates is not one of them. There are great examples of non-premise state laws around servicing and conduct standards and mortgage servicing that really led the way and pioneered national standards. Those are good examples. So I think some compromise on federalism, I'll put that in a 10 to 15 year bucket, and thank God you won't remember I said this 10 years from now, but let's go with that.